Welcome back. My name is Mike Salco, and I'm here on behalf of Bruin Asset Management. You're watching the second part of a three-part video series meant to supplement the case materials you received for the second annual Credit Suisse UCLA Investment Banking Case Competition. In this installment, we're going to be going over the Model tab of the UCLA Case Competition template model that Credit Suisse has provided for us. So in the past video installment, we went over the cover tab and the balance sheet and the income statement. And those are pretty much just copying over line items from the 10K of whichever company that we're modeling in order to get a base from which we can build off of in these next two video installments. So, as you can see, the model tab here is pretty comprehensive, so we're going to go through it step by step. And again, this is not meant to be a guide or a walkthrough in terms of how your model should look exactly. However, this is meant to be a more user-friendly version of the written instructions that Julian's included in this model. So on the model tab, if we look up on the top here, we can see that we've got in the blue bar here the master control panel. So the first thing that you see here is that we've got op case. So we have three choices of operating cases, and this is going to give you a quick way to look at how your LBO is functioning and the returns that you can expect depending on which set of assumptions or projections that you're using lower down in this tab. So we've got operating cases 1 through 3, 1 being your upside, 2 being your base case, and 3 being your downside. And as you can see, as I'm changing these, my IRR over here on the right is changing. And Julian's included these very helpful tabs here to see which year we're accounting for the IRR in. I just rattled off that initialism IRR about 5 times in the last minute. So if you do not know what an internal rate of return is, I highly suggest you go and look it up either on Investopedia or somewhere else on the internet, because the internal rate of return is pretty much the most popular metric that private equity companies use to evaluate how well or how successful their LBO was. And as I said, it stands for internal rate of return. Quick and dirty definition is pretty much the annualized rate with compounding that one would expect to get on their investment. But moving on, we're going to leave stub at 100% because we are not picking up in the middle of a year here. Check must say pass. If it doesn't say pass, you've messed up somewhere on this page, and something that should be zeroing out isn't zeroing out. This is just to keep you on track. Ticker is pretty self-explanatory, and then premium will be the premium to share price for which you're paying for this company. And all of this will make more sense as we go through the model itself. But on this model tab up top, we have our debt assumptions. So in the email that Julian included this model in, you should have a pair of debt assumptions that are specific to the company that you're modeling out. So you can see we have multiple tranches of debt here, which basically just mean different types of loans within their debt, their capital structure. So different lenders, and that's a whole different can of worms to think about in terms of what types of lenders you have. But just think of it as a debt cake, and you've got different layers here. So the tranche 1 will be paid off before tranche 2. And subsequently before tranche 3, and then the 4th tranche over your senior notes will be paid off last. However, you're going to enter in these yellow boxes where the blue type is. You're going to be entering in the assumptions that Credit Suisse has provided you. Everything from how large these tranches are to the leverage, which we've got over here. So again, leverage is going to be a multiple, the total amount of debt divided by your EBITDA, which we talked about in part 1 a little bit, but the EBITDA, like I said, is going to be very indicative of your free cash flows, and so certain lenders will only lend you a certain amount of money depending on how much EBITDA you have. So that's where that comes into play. Tenure, so just the life of the loan. Your rate, so this is your interest rate that you'll be paying on these loans. Again, you could fill out this portion of the model just by copying it from the debt assumptions that Julian has supplied. However, if you want to go far in this case competition, I would recommend understanding what each of these mean. So your interest rate here, you've got L plus 425 bips or basis points, which basically means your LIBOR rate. So your London interbank offer rate, which is essentially the annualized rate at which banks will lend each other money overnight, plus 425 basis points, so plus 4.25%. So that's your interest rate. And then mandatory amortization, how much you have to spread the payment out, and your issue price, so if you're issuing this debt at a discount or a premium, and then financing fees, just an upfront fee that you have to pay this lender to extend you this loan. And then your LIBOR floor, so this is something to protect the lender in case for some reason LIBOR rates go to 0. They're saying the least they're going to pay is a LIBOR floor of 1%. So the lowest coupon rate or interest rate that they're expecting on this debt would be 5.25%, because you got your 1% LIBOR floor plus your 425 basis points. So that is what you want to be thinking about in terms of how expensive this debt is. And you can see that it increases as we move to the more subordinate tranches, because remember, the more subordinate tranches are going to be paid off last in the event of a bankruptcy or if something goes wrong. So they're going to expect a greater return on that. You've got L plus 800 bips on this one. And that will change depending on the assumptions. You'll see that probably the riskier the company that you choose, the more aggressive those financing terms will be. So the bigger discount you have to issue at, and the higher rate you have to pay back on. And that's just because your lenders want more return for their risk. Moving down, we have other assumptions. So your leverage EBITDA, this is pulling from H24, which is further down. We'll get to that. That's a projection or a calculation of our current EBITDA. But then we've got our minimum cash balance. I believe Julian indicated that for this you're just going to go with your most recent cash balance on the balance sheet. So assuming that they keep cash balances where it is before the LBO. Offer price, you're going to input that, and that's going to be based on the premium that you calculate. So here you have the premium that you have to their current share price. Tax rate 35%. Again, I'm pretty sure this is included in the assumptions, but that's pretty typical corporate tax rate. Cash interest rate. Again, this is very down in the weeds here, or kind of like a small detail. I think Julian provides it, but that is the interest rate that you are foregoing on any extra cash when you pay down your debt. And we'll get into that a little bit later. Days in a year, 365. I would just leave that how it is. So moving down into the valuation. This is going to be where you calculate how much you're going to pay for this company. So again, Julian's pretty much summed it up here on the right in this yellow box. But again, you're buying this company, so you want to pay the least amount possible, but you need to offer them something that will satisfy the shareholders and make them agree to the sale. I'm not going to tell you what percentage this should be, and this is really one of the things that will set you apart from other groups in this case competition, is how you calculate the purchase price. But I would look at what similar companies have sold for in a buyout situation, and make sure that your percent premium to their unaffected share price, or their current share price, just make sure it's large enough that the current shareholders will agree to a sale. Then multiplying that by the full shares outstanding, which pulls from lower in this sheet that we'll get to. You're going to come to your equity value. You're going to subtract out cash and cash equivalents, because again, if you buy this company, you're going to get that cash anyway, so you wouldn't really count it as part of the purchase price. If you think about it, if you're going to buy a backpack for 20 bucks, but it's got 10 bucks inside it already, you're really only paying 10 bucks for the backpack. But anyway, moving on. The next input that you have here, all these are calculated for you, but the next input that you have down here would be your basic shares outstanding. So Julian's included a little note. It says it comes straight from the 10K. So look on your 10K, find the amount of basic shares outstanding, and then you're going to calculate these boxes down here, your options outstanding and restricted stock units, to get your fully diluted shares outstanding. You're going to use the treasury stock method. This is something that's taught, I believe, in 1B, but if you're not familiar with the treasury stock method, go ahead and hit up Google, look that up. Basically what you're doing is calculating the amount of dilution that would come to the shares if you were to honor all the options that are currently in the money and pay them off and buy back that stock. See what note Julian has here. Oh, so you can find that strike price in the 10K and then apply the treasury stock method to come up with your outstanding shares, fully diluted shares outstanding. Moving down, we have sources and uses. So this is where you're going to come up on one side with the price that you have to pay for the company, or here in the uses, right? So you have to maintain the amount of cash that they have on the balance sheet already, which I said earlier we pull from their balance sheet. You need to pay off any existing debt that they have, and if you follow that link back, remember we put that in on the balance sheet in the previous video installment. Your equity purchase price, which we calculated up above, and then any financing fees and other expenses, which will be calculated from your debt table up here. But so once you've got all your uses, you're then going to look at how you're coming up with that money. So this is where those EBITDA multiples come into play. So you can see how much money is attributed to your first lien term loan, second lien term loan, and your senior notes, and then your sponsor's equity. So if you think about a leveraged buyout, right? You're buying a company and you're doing the majority of the deal with borrowed money. That's where your debt comes into play. But your private equity sponsor, the sponsor that is in sponsor's equity, is still going to be paying some money for it. So that is where this comes into play. And you want to make sure that that is a healthy percent of the total capitalization. What is healthy? Again, I would go and look up deals that have happened in the market. There are plenty of articles written on LBOs, and look at the leverage ratios that they're using. See how much KKR spent to acquire a company. How much did they pay? How much did they borrow? That's where you're going to get your leverage ratios. So then moving down to your pro forma capitalization, you're going to look at a snapshot of the corporate structure post-acquisition. So after the sponsor buys this company, what immediately is their balance sheet going to look like? This is going to be very similar to your uses table, or your sources table here, because this is essentially a summary of the sources that you're using. But it also gives you some good metrics to see how well you can pay off the interest associated with those loans. So you can see that we've got your net cash interest expense, your CapEx, and then some ratios down here that are pretty much your interest coverage ratios or your leverage ratios. And again, you don't want to see those numbers get too high, otherwise it may not be a viable LBO, but you want to look into that and compare it to similar deals in the past.